Hey everyone, and welcome back. I think we all are trying to find those AI stocks that haven't already gone through the roof. Those hidden gems with a chance for some serious growth. And I think this deep dive might just have what you're looking for.
Yeah, the AI boom has really pushed a lot of those tech stocks up so high, it feels like all the good deals are already gone.
Exactly. But we're diving into this article today called Three Top Bargain Stocks Ready for a Bull Run. And it argues that while everyone is chasing the big names in AI, there are companies out there quietly working on this tech revolution. Companies that might be getting overlooked. And that's where we come in.
It's interesting to me how investors often miss those less obvious connections, like with telecom companies, not exactly what pops into your head when you think AI, right?
Right. When I think AI, I picture self-driving cars and robots. Not exactly. Phone lines.
Exactly. But you have to think about it. All of those incredible AI things rely on really strong networks to even work. Cloud computing, all that data transfer, seamless connectivity. It all needs a powerful telecom backbone. And that's where a company like AT&T comes in. With their massive infrastructure, they could be the unsung heroes of this whole AI age.
Okay, I see what you're getting at, but hold on. Didn't AT&T have some rough times recently? I vaguely remember something about them spinning off parts of their business.
That's right. They did spin off DirecTV and Warner Bros. Discovery. Those segments were really weighing them down. But the interesting thing is that by getting leaner and focusing back on what they do best, they've actually seen some positive results.
Okay, you've got me interested. But are we talking actual progress or just hoping for the best? What's the real deal with AT&T?
Well, let's take a look at how they've been doing lately. They've added almost 1.2 million wireless subscribers and 700,000 fiber subscribers, which is a pretty good sign that people are choosing to go with them. But their revenue for the first 9 months of 2024 actually dipped a little to $90 billion, down from last year.
So more subscribers, but less money coming in. That's kind of confusing what's going on there.
Well, it seems like the rising cost of equipment is a factor, and their net income for the first 3 quarters of 2024 was $6.7 billion. That's a 44% drop compared to last year.
Whoa, 44% less profit. That doesn't exactly sound like a bargain stock.
But here's where it gets interesting. Even though their profits are down, their stock price is actually going up, and their price-to-earnings ratio is sitting at a pretty low 13.
So the stock is climbing even though profits are down. What are people seeing that we're not?
Now that is the million-dollar question. Maybe investors are betting on AT&T's long-term potential in this whole AI world, or maybe they see the value of their restructuring. They might be looking at AT&T's infrastructure as this hidden gem in the age of AI, something that could give them a real edge over the competition.
So it's not just about being a phone and internet company anymore. They could be a major player in the bigger picture of tech.
Exactly. And that's the potential that has investors taking another look at this telecom giant.
Okay, I'm starting to see why AT&T might be worth a closer look. It definitely makes you rethink what an AI stock even means. But let's move on to the next company on our list. Qualcomm. Now, this one feels a little more familiar in the tech world, right?
Definitely. Qualcomm is a name everyone knows, especially for their smartphone chips. But yeah, you're right, there's more to their story than meets the eye, especially when it comes to AI.
Yeah, when I hear Qualcomm, I immediately think of those Snapdragon processors in my phone. But how does that connect to AI?
Well, think about it. AI is getting built into all the devices we use every day. Our smartphones are packed with AI features like voice assistants, facial recognition, even those personalized recommendations you see.
Oh, yeah, for sure. My phone can even identify different plants now just by using the camera. It's actually pretty amazing.
It is. And Qualcomm is right there leading the way. They're meeting this demand for AI capabilities with their new AI-equipped Snapdragon 8 Gen 3 chipset. That puts them in a perfect position for that next wave of smartphone upgrades, as people want even more AI features on their devices.
So they're not just riding the AI wave, they're actually shaping it.
You got it. But what's even more impressive is that they're not putting all their eggs in the smartphone basket. They realize that the future of tech might not be so focused on phones. So they've built whole divisions focused on the Internet of Things, IoT, and automotive technology. They're setting themselves up to take advantage of those growing markets.
That's smart. It's always good to have a backup plan in the world of tech where things change so fast.
Yeah.
So how are these moves affecting their bottom line?
Well, their revenue for the first 9 months of fiscal 2024 reached $29 billion. That's a 6% increase compared to last year. And this is a big deal because it actually reverses the decline they were seeing before. Looks like they've turned things around and are back on a growth path.
6% might not sound huge, But considering how tech has been doing lately, it's actually pretty good,
Right.
right?
Absolutely. And it's not just revenue that's growing. Qualcomm has also managed to slow down how much they're spending on operating expenses, and they've increased their investment income. So all of that together means their net income for the same period was $7.2 billion, which is a jump of 26% compared to last year.
Now, those are the kind of numbers I like to see. A 26% increase in profit. That sounds very promising. But what about their stock price? Has it already caught up with all this good news?
Well, their stock price has been going up over the past year, but it's still trading at a relatively reasonable price-to-earnings ratio of 22.
Hold on a second. Their financials are strong. They're in a great spot in the AI market, which is only getting bigger, and their PE ratio is still lower than a lot of other semiconductor companies.
That's right. And this might be why some investors think Qualcomm is a real bargain right now. Could this be the sleeping giant that's about to wake up and really take off?
It definitely seems like a possibility. So we've talked about AT&T, the unexpected AI player.
Yeah.
And Qualcomm, the chip powerhouse that's changing with the times. Now let's look at our final company in this group of bargain stocks, IBM. This one almost feels like a classic comeback story, right?
Yeah, IBM is a true legend in the world of tech. They've been through a lot of ups and downs, but it seems like they're reinventing themselves once again.
Exactly. It almost feels weird calling them a bargain stock.
Yes.
They've been around forever, but they've been making some really smart moves lately, especially in the AI space.
You're absolutely right. IBM has been on a mission to modernize and adapt. And that move they made in 2019 to acquire Red Hat, that was a game changer. It gave them a top-tier cloud platform and a strong connection to the open source community. Both of those are essential for innovation in cloud computing and AI.
So basically, they bought their way into the cloud game. That's one way to do it. But was it the right move?
It was a bold move, that's for sure. And it seems to be paying off. They've also been streamlining their business by spinning off their managed infrastructure business into Kyndryl. That lets them focus on their core strengths, cloud software, and AI. They're getting leaner and more focused.
And what about AI specifically? What are they doing in that space?
Well, they're going all in on generative AI with their watsonx data platform. Imagine this platform that uses AI foundation models, a data fabric to connect all sorts of data sources, and generative AI to help businesses solve problems and be more creative. That's watsonx.
Okay, so they're not just using AI. They're creating tools for others to use AI as well. That's a pretty powerful position to be in.
Exactly. And you know that focus on open source technology with Red Hat, that makes them even more attractive to developers and companies who want to build their own AI solutions. They're building a space for collaboration, which is so important for fast innovation in the AI field.
It sounds like they have a really solid plan. But are they seeing results? What are their financials like?
So their overall revenue for the first 9 months of 2024 was $45 billion, which is a 2% increase compared to last year. Might not seem like much at first glance.
Not exactly blowing the roof off with revenue growth.
Yeah.
But is there anything good in those numbers?
Absolutely. If you look closer, their software segment, which includes the cloud and watsonx, actually saw revenue jump by 8% in that same period. This clearly shows that their focus on these areas is starting to pay off.
So the areas where they're putting in the most effort are showing the strongest growth. Makes sense. But what about profits? Are they actually making money?
Well, they have had a few bumps in the road when it comes to profits. Their net income for the first 3 quarters of 2024 dropped to $3.1 billion, down from $4.2 billion in the same period last year. This is partly because of some investment losses and the ups and downs of foreign currency.
Yeah, the joys of the global economy. But are these lower profits a sign of trouble or just a temporary thing?
It's important to remember that even with these dips in profit, IBM stock has actually reached record highs.
Record highs. But profits are down. Something doesn't seem right here.
It does seem a little strange, doesn't it? But it tells us that investors are looking past those short-term ups and downs, and they're seeing the long-term potential of IBM's transformation.
So they're betting on IBM's comeback.
Exactly. And with a PE ratio of 24, there's still room for growth, which makes IBM a very intriguing investment opportunity.
This is all starting to make sense. We've got AT&T, the telecom giant, quietly powering AI infrastructure. Qualcomm, the chip maker, evolving to keep up with those AI-powered devices. And IBM, the classic tech company, reinventing itself with a focus on cloud software and generative AI.
And all three of them, even with their different stories and challenges, are showing signs that they might be undervalued, making them potential bargains in the AI market.
Wow, this has been a really eye-opening deep dive so far. But don't go anywhere. We're just getting started. In part 2, we'll dig even deeper into these companies. We'll look at the risks, the opportunities, and what you should think about before making any investment decisions. See you soon.
Welcome back. Hope you're ready to go even deeper because we're about to really break down these fascinating AI bargain stocks. It's time to look beyond the surface and figure out what makes these companies tick.
I'm ready. We've kind of sketched out these profiles for AT&T, Qualcomm, and IBM, but like with any investment, it's all about the details. So what are some of those crucial things investors should really be thinking about when they look at these companies? Especially with this whole AI boom going on.
That's the big question, right? And remember, we're not giving out financial advice here. This whole deep dive is about giving you the knowledge to make your own smart decisions. Decisions based on really understanding what's going on. And with that in mind, let's start with the big one. Risk. Every investment comes with some risk, and these companies are no different.
For sure, there are no guarantees when it comes to the stock market. So let's get down to specifics. What are some of the potential risks with AT&T? We talked about their profits going down. Is that a big red flag for investors?
It's definitely something to watch closely. Their subscriber growth and that restructuring they did are good signs. But they have to turn those wins into consistent profits. Investors want to see proof that they can control costs, boost revenue, and actually improve their bottom line. It's got to be about sustainable growth, not just short-term gains.
And what about competition? The telecom industry is super competitive. Can AT&T really keep up with those giants like Verizon and T-Mobile? Especially as the tech world keeps changing so fast.
Competition is always there in this industry, no doubt. AT&T has to keep innovating, offer good plans, and be aggressive about expanding their 5G and fiber networks. They got to stay ahead of the game. But it's not just about having the best connection anymore. They also need to show that they can use their existing infrastructure to become a big player in AI and cloud computing. Think about it. What if they could offer businesses custom AI solutions all powered by that massive network they have?
That's a really interesting idea. So they're not just a phone and internet company anymore. They need to be a vital part of that whole tech world.
Exactly. That's where the real potential for growth is. But there's another thing to consider. Regulations. The telecom industry is heavily regulated. Any changes to those regulations could have a big impact on AT&T.
So investors need to be aware of potential laws or policy changes that could affect how AT&T does business. Sounds like a lot to keep track of.
It is, but you know what they say, knowledge is power. The more you understand about what's happening, the better decisions you can make. Okay, let's move on to Qualcomm. What risks and opportunities do you see with them?
Well, we talked about how much they rely on the smartphone market.
Yeah.
And that feels a little risky. What if people stop buying as many smartphones? Or what if they lose market share to other companies? Tech moves so fast, how can they keep up?
You bring up a good point. The smartphone market goes up and down, and Qualcomm is definitely tied to that. They have to stay ahead of the technology curve, keep making cutting-edge chips, and secure those deals with the big phone makers. It's a constant race to stay in front.
But they are making moves to branch out, right?
Yeah.
We talked about them going into IoT and automotive. How are those efforts going? Are they getting any traction?
Those are definitely areas where they could really grow, new ways to expand beyond just smartphones. But those segments are still pretty small compared to their main smartphone business. So investors will be watching to see if Qualcomm can really establish themselves in those new markets. Can they make serious money from them? It's all about execution and showing that they can actually do what they're planning.
So they have the ideas, but can they make them happen? That's the real question.
Exactly. And let's not forget about the competition. They've got other chip makers to worry about, both the big names and some ambitious startups. The semiconductor industry is always changing. Qualcomm has to stay on the cutting edge to stay on top.
Wow, it sounds like Qualcomm has a lot of pressure to perform. But if they can do it, the rewards could be huge, right?
Absolutely. They're in a prime spot to ride that AI wave, both in smartphones and in all those new applications. But as always, investors need to carefully weigh those risks and opportunities before making any decisions.
Good advice. Okay, let's switch gears to IBM. They've had an amazing comeback story. But what are some challenges they face in this ever-changing tech world? Can they really shake off that old tech image?
That's a big hurdle for them, for sure. They have to constantly show that they're not stuck in the past. They need to be seen as a forward-thinking company that's embracing the future of cloud computing AI and these hybrid cloud solutions. It's about changing how people see them, showing everyone that they're committed to cutting-edge technology.
But they're going up against some serious competition in the cloud market, aren't they? Can they really compete with giants like Amazon Web Services and Microsoft Azure? Those are some big players.
It's definitely a David versus Goliath situation in some ways. But IBM's strength is in working with those big enterprise clients. And their expertise in hybrid cloud solutions, those are the setups that combine public and private cloud environments. They're not trying to be everything to everyone. They're going after a specific niche with specialized needs.
So they're playing to their strengths and focusing on a particular part of the cloud market. Interesting strategy.
Exactly. They're using their experience and deep understanding of what big companies need to offer solutions that solve those specific problems. But of course, even in that niche, they still have to prove themselves. They have to convince those clients that they're the best choice.
Right, having a plan is one thing, but making it work is another. What are some key things IBM needs to do to win over those big clients?
They need to keep investing in their cloud platform, expanding what they offer, and constantly proving that they can deliver. Those reliable, secure, and scalable solutions that businesses need today. It's about building trust, showing their expertise, and proving that they can really partner with businesses to help them achieve their goals.
So it sounds like IBM's success really depends on how well they execute this hybrid cloud strategy
Yeah.
and how well they win over those enterprise clients. But they also have to manage this whole transition they're going through, don't they? They've been restructuring and selling off parts of their business, and that can be tough.
You're absolutely right. Managing this change smoothly and making sure it doesn't mess up their core operations, that's super important for their long-term success. They can't afford to make any mistakes as they go through this critical stage. And of course, they have to keep pushing the limits with their AI capabilities, building on the success they've had with watsonx.
So IBM has a lot to juggle, but it sounds like they have a clear vision and a solid plan.
They do. And that's why investors are taking notice. But remember, every investment decision comes down to your own goals and how much risk you're comfortable with. It's crucial to do your own research, think about your financial situation, and make informed choices that match your investment strategy.
Wise words. So we've explored those potential risks and opportunities with AT&T, Qualcomm, and IBM, but let's not forget the bottom line. Valuation. How can investors figure out if these stocks are really bargains? We've talked about PE ratios, but are there other things we should consider?
Absolutely. PE ratios are just one piece of the puzzle. To really figure out a company's value, we need to look beyond those simple metrics and get into some more sophisticated valuation methods. That's what we'll cover in part 3 of this deep dive. Stay with us.
All right, welcome back, everyone. We're in the home stretch now of our deep dive into these AI stocks that might be flying under the radar, those potential bargains that could really boost your portfolio. We've talked about the companies, the strategies, the risks, and the opportunities, and now it's time to get down to the numbers and talk valuation.
Exactly. You know, it's easy to get swept up in the excitement, especially in a hot market like AI. But when it comes to investing, it's all about making smart financial decisions. And that means looking at the data.
And that's where valuation comes in, right? It helps us see past the hype and figure out if a stock is really a good deal. We've talked about price to earnings ratios, but are there other tools we can use to see if a stock is truly undervalued?
Oh, there are tons of ways to value a company, and it can get pretty complicated. But let's stick with those PE ratios for now and introduce a couple more metrics, ones that can be really helpful when we're looking at tech and AI companies.
Sounds good to me. But first, a quick refresher for everyone listening. Can you remind us what exactly that PE ratio tells us about a company?
Sure. Think of the PE ratio as a way to measure how much investors are willing to pay. For every dollar of a company's earnings, you calculate it by dividing the current stock price by the company's earnings per share.
So basically, a higher PE ratio means investors are more optimistic about the company's future growth. They're willing to shell out more money today because they think those earnings will really take off down the line.
That's it. A high PE ratio can definitely be a sign that investors have big expectations for the company. But, you know, it can also be a warning sign, especially in a market where there's a lot of hype. Sometimes the excitement can overshadow the actual fundamentals.
Right, so there's no magic number when it comes to PE ratios. It's all relative.
Yeah.
You have to look at a company's PE ratio compared to others in the same industry, its own history, and what the market as a whole is doing to get a real idea of whether it's undervalued or overvalued.
You got it. Context is key. Now let's talk about another helpful metric, the price to sales ratio, or PS ratio for short. This one compares a company's market value to its annual revenue. So it gives us an idea of how much investors are paying for each dollar of sales the company makes.
Okay, so how is the PS ratio different from the PE ratio, and why is it especially useful for tech and AI companies?
Well, the PS ratio can be really insightful for companies that are still in those early stages of growth, or for companies that aren't making a profit yet. which happens a lot with those up-and-coming tech and AI companies.
I see. So a company might have a high PS ratio because investors are excited about its future revenue, even if it's not profitable right now.
Exactly. It's a way to look at a company's growth potential and how much of the market they're capturing, even if their earnings haven't caught up yet.
That makes sense. Okay, so we've got PE ratios and PS ratios. Are there any other valuation tricks we can use to dig even deeper into these AI stocks?
Absolutely. If we really want to get into the weeds, we can use something called discounted cash flow analysis, or DCF for short. This method is all about forecasting a company's future cash flows and then discounting them back to their present value.
Okay, that sounds a little complicated. Can you explain it in a way that's easier to understand?
Sure, basically DCF analysis tries to figure out what a company is really worth based on how much cash it's expected to generate in the future. It's a way to look past what the company is earning right now and get an idea of its long-term earning power.
So it's a more forward-looking approach.
You got it. It's all about figuring out how much cash a company can generate in the future, and then figuring out how much that future cash is worth today. It's a powerful tool, but it does mean making some assumptions about future growth rates, discount rates, and other factors.
I see. So it can give you some great insights, but it also takes a bit more expertise and judgment compared to those simpler metrics like PE and PS ratios.
That's right. It's not a one-size-fits-all kind of thing. The best way to value a company really depends on the company itself and what stage of development it's in. All right, let's try applying these concepts to our three companies.
Yeah, let's do it. We talked about AT&T having a PE ratio of 13, which seems pretty low, especially when you compare it to all those high-flying tech stocks we always hear about. Does that mean AT&T is a must-buy?
Well, hold on a minute. Remember, we got to look at the whole picture. AT&T is facing those profitability challenges we talked about, and investors might not be willing to pay a premium for the stock until they see some real improvement. They want to see those profits heading in the right direction.
So that low PE ratio could actually be a sign that the market is unsure about AT&T's future, even though they have that valuable infrastructure.
Exactly. It's that classic risk versus reward situation. Investors are trying to weigh the potential upside of AT&T's network against the uncertainty about their earnings. But this could also be a good opportunity for investors who think AT&T is undervalued and who believe that those strategic moves they're making will pay off down the road.
Okay, so it's a gamble on whether they can turn things around. What about Qualcomm? Their PE ratio is 22, which is higher than AT&T's, but still lower than a lot of other chip makers. What does that tell us?
Qualcomm's PE ratio suggests that investors are feeling pretty good about their chances for growth, especially with their success in the smartphone market and their push into new areas like IoT and automotive tech.
Yeah, we talked about how they're not just a smartphone chip company anymore. They're branching out and getting ready for growth in those new markets.
Exactly. And their PE ratio hints that there might be some room for the stock to go up if they can make that diversification strategy work and take advantage of that growing demand for AI chips.
So Qualcomm is kind of a balance between risk and potential reward.
Right.
What about IBM? They have a PE ratio of 24, the highest of the three companies we've been talking about. Why are investors willing to pay more for IBM compared to AT&T and Qualcomm?
Well, IBM's PE ratio shows that the market believes in their comeback story and their focus on those high-growth areas like cloud computing and AI. Investors are happy to pay a bit more for a company that's reinventing itself and showing they're all in on cutting-edge tech.
Well, it's all about that transformation, right?
Mm-hmm.
Getting rid of those old businesses and investing in the future.
You got it. But again, it all comes down to execution. They have to deliver on those promises and show they can really compete in those tough markets. To justify that higher price tag,
right, valuation metrics like PE ratios can give us some clues. But they're just one piece of the puzzle. We have to look at a company's overall financial health, their management team, who they're competing with, and their long-term growth potential.
Absolutely. It's all about connecting the dots and seeing the big picture. Investing is more than just looking at numbers on a spreadsheet. It's about understanding the story behind those numbers and making smart decisions based on a complete view of the company's strengths and weaknesses.
Wow, this deep dive has given us a lot to think about. We've explored these three potential AI bargain stocks. AT&T, the telecom giant with a low PE ratio but facing those profitability challenges. Qualcomm, the chip maker with a moderate PE ratio and some solid growth prospects as they expand into new areas. And IBM, the old-school tech company with a higher PE ratio and a really interesting turnaround story as they reinvent themselves for this new era of AI.
Each of these companies offers a unique investment opportunity with its own risks and rewards. It's all about finding the opportunities that match your own investment goals and how much risk you're willing to take.
So what's the bottom line for our listeners? What should they do as they explore these potential investments?
The most important thing is to do your own research. Don't just take our word for it. Really dig into those company financials, analyze their strategies, and think about how they fit with your own goals and risk tolerance. And remember, the world of investing is always changing, especially in a field like AI that moves so fast.
Exactly. Sometimes those companies you least expect can turn out to be the best investments. Who would have thought a telecom company could be an AI play? Keep your eyes open, stay informed, and be willing to think outside the box. And most importantly, never stop learning.
Couldn't have said it better myself. That journey of knowledge never ends, especially in the exciting world of AI investing.
Thanks for joining us on this deep dive into those potential AI bargain stocks. We hope you've learned some valuable things to help you on your investing journey. And remember, the best investments are the ones that are well-researched, well-understood, and match your own individual goals and risk profile. Happy investing, everyone.